In the year 1720, Sir Isaac Newton, the man who formulated the laws of motion and universal gravitation, and one of the most intelligent human beings who ever lived, lost a fortune, the equivalent of millions of dollars today, in the South Sea Company stock bubble. After the crash, he famously lamented, "I can calculate the motion of heavenly bodies, but not the madness of people." This was not a failure of intelligence. It was a failure to resist the single most powerful, destructive, and seductive force in financial markets: the pull of the herd. In the next 10 minutes, you will learn the psychological and neurological drivers of herd mentality, how this ancient survival instinct creates devastating boom and bust cycles, and a specific contrarian framework for inoculating your investment portfolio against the madness of the crowd. Herd mentality, or herding behavior, is the tendency for individuals to mimic the actions and follow the beliefs of a larger group, often while ignoring their own independent analysis. In finance, it is the irresistible urge to buy what everyone else is buying during a mania, and to sell what everyone else is selling during a panic. This is not a character flaw. It is a deeply ingrained survival instinct. For our prehistoric ancestors on the savannah, conformity was a life-saving heuristic. When the entire herd suddenly started running, the individual who stopped to ask why was the one who was eaten by the lion. Sticking with the group, assuming they knew something you didn't, was a powerful and effective survival strategy. We are the descendants of those who ran with the herd. This instinct manifests in markets through a mechanism called an information cascade. It begins when a few people make a decision. Others, assuming the first movers are better informed, follow suit. Their actions then signal to others, who also follow, and the process snowballs. The action of the crowd itself becomes the only piece of information that matters, creating a self-reinforcing stampede based on imitation, not information. This ancient programming, designed for physical survival, is a catastrophic liability in the world of investing. It is the engine of every speculative bubble and every panicked crash in financial history. So, how does this psychological flaw mechanically create these cycles? And what are the telltale signs that you are being swept up by the herd? The destructive power of herd mentality is most clearly seen in the anatomy of a classic financial bubble. This five-stage pattern, first outlined by the economic historian Charles Kindleberger, is a perfect map of the herd in motion. Theory: the 5 stages of a bubble. Displacement. It begins with a spark. A new, paradigm-shifting technology or a major economic event creates a new, legitimate investment opportunity. Think of the birth of the internet in the 1990s. Boom. Prices for assets related to this new paradigm begin to rise. Early, well-informed investors make significant profits. Euphoria: the public takes notice. Stories of overnight millionaires spread. The fear of missing out, or FOMO, becomes overwhelming. The herd begins to stampede into the asset class, pushing prices to levels completely detached from underlying reality. You hear the mantra: this time it's different. Profit-taking. The smart money, the early investors who understand intrinsic value, recognize the mania. They begin to quietly sell their holdings to the euphoric incoming herd. Panic. A trigger event causes the bubble to pop. The herd, which bought at the peak, now stampedes for the exit in a state of sheer panic, selling indiscriminately at any price to get out. Analogy: the nightclub line. Imagine you are walking down a city street at night. You see a nightclub with a massive line of people waiting to get in. You know nothing about the club, but your brain's herding instinct immediately tells you that must be the best club on the street. That's an information cascade. So you join the line. Other people walk by, see the line is now even longer, and they join too. The line itself becomes the social proof of quality. What nobody in the line realizes is that the first 20 people were paid by the club owner to stand there to create the illusion of popularity. When those paid actors finally leave, profit-taking, the rest of the line can quickly dissolve into chaos as people realize they were just following each other. Example, the dot-com bubble. This classic bubble followed the pattern perfectly. The displacement was the creation of the commercial internet. The boom saw early internet stocks deliver incredible returns. The euphoria phase from 1998 to early 2000 saw any company with a .com in its name achieve an astronomical valuation, regardless of profits or even revenue. The panic was the brutal crash from 2000 to 2002, which wiped out trillions of dollars of wealth as the herd stampeded out of the technology sector. This is why a sound wealth management plan is built on principles, not popularity. Resisting the powerful emotional pull of the herd is one of the most difficult skills in investing. There are two primary psychological traps you must learn to recognize. Pitfall number 1. The fear of missing out, FOMO. This is the emotional fuel of the euphoria phase. It is not an analytical decision. It is a primal fear of being left behind while your peers get rich. It is driven by envy and the deep-seated human need for social validation. Pitfall number 2. The safety in numbers illusion. This is the belief that if a large number of people are doing something, it must be the correct and safe course of action. In life, this is often true. In investing, the opposite is usually the case. By the time an investment is popular enough to be a topic of conversation at a dinner party, the greatest gains have almost certainly already been made, and the risk is at its absolute highest. The world's greatest investors don't just resist the herd, they actively profit from it. They have a specific mindset that turns the crowd's predictable folly into their greatest advantage. The advanced strategy, the contrarian framework. A contrarian is not someone who simply does the opposite of the crowd. A true contrarian is a disciplined analyst who uses the crowd's emotion as a key piece of data. Invert. Always invert. This is a mental model from the legendary investor, Charlie Munger. When confronted with a popular investment thesis, you must not ask, what are the reasons this could be right? Instead, you must relentlessly ask, what is the most compelling, evidence-based argument for why this popular belief could be catastrophically wrong? This forces you to seek out disconfirming evidence, the natural antidote to the herd's echo chamber. Measure the emotion. You can measure the herd's sentiment objectively. Indicators like the CNN Fear and Greed Index or the American Association of Individual Investors Bull-Bear Ratio are powerful tools. When these indicators are at extreme greed, the herd is euphoric, and the contrarian becomes extremely cautious. When the indicators are at extreme fear, the herd is panicking, and the contrarian is sharpening their pencil, looking for bargains. Internalize Buffett's rule. The entire philosophy can be distilled into Warren Buffett's timeless advice. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. The professional investor's job is to be the rational counterparty to the herd's predictable emotional mistakes. They sell their shares to the greedy buyers at the top, and buy those same shares back from the fearful sellers at the bottom. Let's distill this into the 3 essential principles for surviving and thriving amidst the madness of crowds. Herding is a survival instinct, not an investment strategy. Your brain is hardwired to find safety in the consensus of the crowd. In financial markets, this instinct is a catastrophic liability that creates predictable boom and bust cycles. Bubbles follow a predictable emotional path. The 5 stages of a financial bubble, displacement, boom, euphoria, profit-taking, and panic, are a roadmap of herd psychology. Your job is to recognize the overwhelming emotion of the current stage. The antidote is disciplined contrarianism. The advanced strategy is to be fearful when others are greedy, and greedy when others are fearful. Use sentiment indicators to measure the crowd's emotion and act as the rational provider of capital when they are euphoric and the rational buyer of assets when they are panicking. The herd will lead you to comfort, to consensus, and eventually to slaughter. The path to superior returns is a lonely one. If this analysis provided you with real value, invest a single click in the subscribe button to get daily access to the Codex. Knowledge is the new capital. We'll see you tomorrow.